For decades, the dollar has done what no army could. It made U.S. power global by making U.S. debt desirable. But today, central banks are buying less. Gold is making a comeback. Allies are hedging, and adversaries are building alternatives. This isn't the end of the dollar. But it may be the beginning of a transition, from unquestioned reserve status to something more competitive, more fragile, and more political. Trace the privileges the dollar grants, and the risks they now carry. Engage.
We're into something really fundamental, something that touches global finance and likely your wallet too. The U.S. dollar and Treasury bonds. It's a huge topic, really the bedrock for so much international activity. And lately, some of the material you've shared suggests there might be some shifts happening, maybe even some cracks showing in global confidence.
Yeah.
So our mission today, based on this stack of sources you've given us, we've got recent articles, research on the bond markets, some analysis of the dollar's role, is to try and figure out what's really going on. Is the world's faith in the dollar and U.S. debt actually changing? And if it is, what could that mean for you here in the U.S. and maybe for the country's place in the world?
It means we need to look at specific data points, understand the mechanics of these markets, which can get pretty complex, and maybe even look at some history. It's really about understanding the forces at play right now based strictly on the material we have here. So not crystal ball gazing, but making sense of the current landscape according to these sources.
Let's into it then. Our sources seem to focus on a few key areas. Recent market indicators, right? Then the mechanics, like how bond demand shifts actually hit interest rates and inflation. And then there's this huge question hanging over it all. What happens if the U.S. dollar starts to lose its spot as the world's go-to currency? So let's start with those indicators. What does the recent activity in the markets tell us? According to the sources, are global investors actually pulling back from U.S. bonds or the dollar?
Well, what the material suggests is it's an evolving picture, definitely not a sudden collapse or anything like that. But yeah, you could say there's a more nuanced sentiment among global investors now. One key signal the sources point to is the share of total U.S. public debt held by foreigners. Now, the actual dollar amount held by foreigners has grown because the debt itself has grown, but their share has actually fallen. It was around 35% back in 2020, and by December 2024, it was down to about 30%.
So that means the U.S. government is having to rely more on buyers right here at home.
That's what it indicates, yes. More reliance on domestic buyers to absorb that increasing debt.
And it's interesting, the sources show that not every foreign country is reacting the same way. There's a divergence.
You see quite different strategies. China, for example, has been reducing its holdings for several years now. The sources mentioned they went from over $1 trillion before 2022 down to around $800 billion by late 2024.
Wow.
And reports link that to their own goals, like managing their currency, but also geopolitical factors. But then on the other hand, you have the United Kingdom, which has significantly increased its holdings over that same period.
Really?
Yeah. And Japan is still the largest foreign holder, but its share has also dipped slightly. So it's not like a unified global move against the US. It's more like individual countries making strategic choices based on their own circumstances.
And is there also something in the sources about who among foreigners is holding the debt? A shift there too?
Yes, that's another interesting point the material raises. It seems private foreign investors now hold a larger slice of U.S. treasuries than the official institutions, like central banks. The numbers cited are about 55.8% private versus 44.2% official by December 2024.
And why does that matter?
Well, private investors are generally thought to be more focused on yield and risk return. They're looking for the best investment. Official institutions might hold treasuries for different reasons, reserve management, strategic diversification, things like that. So a bigger share held by private investors could potentially make the market more sensitive, more reactive to economic news or policy changes.
Okay, that makes sense. So moving from who holds the debt to the actual buying process, what about those treasury auctions? The sources seem to flag those as pretty important.
They are, definitely. And the sources do highlight some, let's say, signs of caution there recently. They talk about weak or disappointing auctions, particularly in the spring of 2025. For instance, there was an April 2025 auction for 7-year notes. Foreign participation, which they measure partly by looking at indirect bidders, typically foreign central banks, and big institutions, was lower than average, only 59.3%, which the sources say was the lowest since late 2021.
So what happens then? Who buys the rest?
Well, the primary dealers, those are the big banks that are obligated to bid. They had to step in and buy a larger share than usual. And maybe even more telling, a May 2025 auction for 20-year bonds. That one reportedly cleared at a significantly higher yield than the market expected.
Higher yield meaning the government has to pay more interest.
And according to the sources, that auction result actually triggered some sell-offs in the wider market and weakened the dollar right afterwards.
So why were those options considered weak? What's the underlying message from investors there?
The material connects it pretty directly to growing investor anxiety. Concerns about the sheer amount the U.S. government needs to borrow because of budget deficits, and just general worries about fiscal stability. Now, it's important to note, these weren't failed auctions. Demand still met supply. A true failed Treasury auction is incredibly rare.
Okay.
But it signals that investors are demanding more compensation, those higher yields, to absorb the new debt hitting the market. It's like they're repricing U.S. risk in real time, given the fiscal outlook and other uncertainties. That's a really key takeaway from those auction reports.
And how does the dollar's role in global reserves fit into all this? Is that changing too?
Well, the latest IMF data mentioned for Q4 2024 actually showed a small increase in the dollar share of global reserves up to 57.8%.
Oh, so that goes against the trend.
Not exactly. The sources are quick to clarify that this uptick was mostly due to valuation effects, meaning the dollar itself got stronger against other currencies during that period. So the existing dollar reserves were simply worth more when measured. It wasn't necessarily central banks actively going out and buying more dollars.
Oh, got it. An accounting thing almost?
Pretty much. The underlying longer-term trend the sources point to is still a gradual decline from the dollar's peak share, which was around 71% back in the early 2000s. What we're seeing is reserve managers slowly diversifying, not rushing into one single alternative, but spreading their holdings across a basket of currencies, and notably into gold. Central banks, according to the sources, were buying gold at the fastest pace in decades between 2022 and 2024.
Interesting. So if you put all these indicators together, the foreign holdings share, the auction demand, the reserve diversification, the gold buying in, it sounds like the message isn't panic, but maybe more caution, more selectivity.
It seems like a fair summary based on the sources, yeah. Investors are becoming more discerning, they're demanding higher yields to take on U.S. debt, and they're slowly broadening their portfolios.
So the overall structure, the dollar's dominance, it's still there,
Yeah.
but that exorbitant privilege, the ability to borrow huge amounts super cheaply, that's being tested a bit at the edges.
That's a good way to put it. The privilege is still there, but it's facing headwinds. The ease of finding buyers at low cost isn't quite as automatic as it perhaps once was.
Wait, let's shift gears slightly and talk about the mechanics. If these signs did escalate, if we saw a really large-scale sell-off or just a sustained lack of demand forcing yields much higher, what happens then? What are the real-world impacts for things like interest rates and inflation that affect all of us?
This is where it gets really tangible. It connects directly to borrowing costs right across the economy. When major investors sell treasuries, or if demand just isn't there for new ones, it pushes bond prices down.
The basic bond math. Lower price means higher yield for the next buyer because the coupon payment is fixed. Yield, coupon price.
Lower price, higher yield. And the thing is, U.S. Treasury yields, especially things like the 10-year yield, they are the benchmark for so many other interest rates. So if Treasury yields spike, it almost inevitably leads to higher mortgage rates, higher borrowing costs for companies wanting to invest or expand, higher rates on car loans, credit cards, you name it. The sources explicitly mention that the rise in 10-year Treasury yields in 2022-2023 was a key factor in pushing 30-year mortgage rates up over 7%.
So less global appetite for U.S. debt directly means the U.S. government has to pay more to borrow. And because Treasury rates are the foundation, pretty much everyone else ends up paying more to borrow too.
Precisely. From the federal government down to homeowners and small businesses, the cost of financing goes up. Now, the scale of that impact obviously depends on how big the sell-off or the shift in demand is. The mechanism is clear.
And what about inflation? How do these higher interest rates driven by bond market shifts affect the prices we bid?
This relationship, the sources note, is actually pretty complex. There can be forces pulling in different directions. But generally speaking, rising interest rates and yields mean tighter financial conditions overall. Money becomes more expensive to borrow. That tends to cool down economic demand over time. Businesses might postpone investments. Consumers might cut back on big purchases.
Right?
And lower demand usually puts downward pressure on prices. So in the medium term, higher rates driven by bond yields tend to be disinflationary, meaning they work against inflation. We saw this dynamic play out in 2022, 2023. The Fed was hiking rates aggressively, Treasury yields were rising, and that combination definitely helped cool inflation down from those really high peaks above 9%.
But wait, the sources also said that inflation fears can actually cause a bond sell-off, didn't they? That seems like the reverse.
Yes, that's the other side of the coin. That's the reverse causality. If investors expect higher inflation in the future, they know that inflation will erode the real value of the fixed payments they get from their bonds. So they'll demand a higher yield now to compensate for that expected loss of purchasing power. That demand for higher yields pushes bond prices down. People sell existing bonds to buy new ones with better yields or just demand more at auctions. The sources point to mid-2022 when U.S. inflation was hitting those 40-year highs as a time when inflation fears were a major driver pushing Treasury prices down and yields up. So in that sense, the yield spike can be a symptom of inflation worries. But then those very same higher yields become part of the cure because they help slow down the economy and eventually curb inflation. It's a feedback loop.
Got it. And what role does the dollar's exchange rate play in all this?
That adds another layer. If foreign investors are selling U.S. bonds and then taking those dollars and converting them into, say, euros or yen, that selling pressure on the dollar can weaken its value.
And a weaker dollar makes imports more expensive for us here.
If the dollar falls, the price of imported goods goes up, and that can directly add to domestic inflation. However, the sources also point out that it doesn't always work that way. Sometimes, like we saw in 2022, rising U.S. yields, maybe driven by Fed tightening, actually attract other foreign investors who are looking for better returns.
Higher yield attracts capital.
Precisely. And that inflow of capital can actually strengthen the dollar. A stronger dollar makes imports cheaper, which helps dampen inflation.
So it could go either way.
The net effect on inflation from a bond sell-off and the related currency moves can vary depending on the circumstances. But the sources suggest the dominant impact from the higher interest rates themselves is usually disinflationary because it slows down overall demand in the economy.
Okay, that clarifies the mechanics. Now let's tackle the really big long-term question that looms in these sources. The potential risk of the US dollar losing its status as the world's primary reserve currency. They call this the exorbitant privilege. First, what does that status mean, and what are the consequences if it really starts to erode?
Right, that exorbitant privilege. It basically comes from the fact that governments, central banks, big companies, investors all around the world hold massive amounts of their savings and reserves in dollar-denominated assets, especially U.S. Treasury bonds. This creates this huge sort of automatic, constant global demand for dollars and U.S. debt. And that demand allows the U.S. government to borrow vast sums of money more cheaply and easily than it otherwise could. The sources estimate this saves the U.S. government maybe 0.5% to 1% of GDP every year in lower interest payments. That's a lot of money.
It's huge.
And it's been a major pillar of U.S. financial power and even geopolitical influence really since the end of World War II.
So if that special status starts to fade, what's the potential fallout according to the sources?
Well, the sources outline some pretty significant potential consequences, mainly macroeconomic ones. The most direct impact would likely be structurally higher interest rates for the U.S. If global demand for treasuries falls off permanently, the U.S. loses that built-in base of cheap credit. Rates have to go up to attract enough buyers.
So that borrowing advantage disappears.
Financing the U.S. government's deficits, which are already large, becomes much more expensive. Even a modest, sustained rise in borrowing costs could add hundreds of billions of dollars to the national debt each year, just in interest payments. That puts immense pressure on the federal budget.
Which, as you mentioned, could force some really tough choices down the line.
The sources suggest the U.S. might find itself forced into what they call fiscal consolidation. That means potentially making significant cuts to government spending programs or implementing substantial tax increases or some combination of both. It could make it much harder to fund everything from domestic initiatives to, as one source specifically notes, maintaining current levels of military spending. Those guns versus butter trade-offs become much sharper, much more difficult.
And beyond the budget, what about the dollar's value itself and inflation?
Well, if the world needs fewer dollars for trade and reserves, basic supply and demand suggest the dollar's value would likely weaken over the long term. And as we just discussed, a weaker dollar generally means imports become more expensive, which fuels domestic inflation.
Right.
The U.S. might also face more volatility in its exchange rate, making planning harder for businesses and potentially eroding the purchasing power of Americans. The sources even suggest the Federal Reserve could face a nasty dilemma in that scenario.
How so?
They might have to choose between hiking interest rates really aggressively to try and prop up the dollar and fight the resulting inflation, but potentially choking off economic growth, or they could let the currency fall and basically accept higher inflation as the price of avoiding a deep recession. Not a great set of options.
No, definitely not. The sources also connect this dollar dominance to U.S. power on the world stage, right?
Yeah.
Geopolitically.
Yes, that's a really critical dimension they bring up. The dollar's central role gives the U.S. unique financial leverage. Think about international trade. So much of it is still invoiced and settled in dollars, often passing through U.S.-linked banks, even if the U.S. isn't directly involved in the trade. That gives Washington enormous insight and enormous power. The sources highlight the ability to impose financial sanctions as a key example. The U.S. can effectively cut countries or entities off from the global dollar system, which can be crippling economically.
Powerful foreign policy tool.
Hugely powerful. But if the dollar's role shrinks and alternative systems develop, that sanctions tool becomes less potent. And the sources note that this is precisely why rivals like China and Russia are actively working on de-dollarization. They want to reduce their vulnerability to that kind of U.S. financial pressure.
So losing dollar dominance could mean losing a key instrument of a financial statecraft.
Yes, losing some of that unique leverage. And the sources even link it back to military spending again. Part of the reason the U.S. has been able to afford large defense budgets and maintain a global military presence is because it could borrow so cheaply.
With cheap funding.
If borrowing costs rise significantly due to lower dollar demand, that could put real constraints on defense spending, potentially leading to a smaller U.S. military footprint around the world, which in turn could create power vacuums or shifts in regional balances. And naturally, the sources point out that if the dollar falters, other currencies and the powers behind them stand to gain. We could see a gradual shift towards a more multipolar currency system. Maybe the euro, maybe the Chinese renminbi gain larger roles over time. This would validate the efforts of countries pushing for de-dollarization and could reshape alliances and global influence patterns.
So those are some pretty profound potential consequences. Given how high the stakes are, what could actually trigger such a loss of status? The sources talk about triggers. And I mean, is it imminent?
Well, first, the sources emphasize that these major shifts in reserve currency status are historically very rare. They usually happen only after huge global disruptions, think world wars, major economic collapses. And the dollar is, let's face it, deeply entrenched. It still accounts for nearly 60% of global reserves, according to the 2024 data cited. And right now, there isn't a single clear alternative that offers the same combination of safety, liquidity, meaning ease of buying and selling large amounts, and just sheer convenience.
But sticky, but not invulnerable. What factors could erode it?
The material identifies several potential pressure points, or in more extreme scenarios, triggers. One major one is the U.S. fiscal trajectory. If global investors lose confidence in the U.S. government's ability or willingness to manage its debt and deficits sustainably, that could be a big problem. Think repeated political standoffs over the debt ceiling, or just continuously rising debt to GDP ratios without a clear plan. The sources note that credit rating agencies have already cited political gridlock in past downgrades.
The political risk factor.
Another factor is inflation and Fed credibility. If the U.S. were to experience persistently high inflation, or if there were a perception that the Federal Reserve was losing its independence from political pressure, that could seriously damage trust in the dollar's long-term value. Then there's the weaponization point we discussed. If the U.S. uses its dollar power, like sanctions, too aggressively or perhaps unilaterally, it could accelerate the push by other countries to build and use alternative financial channels.
Kind of pushing them away.
Potentially, yes.
Yeah.
Also, just the relative decline of the U.S. economy compared to the rest of the world. If the U.S. share of global GDP continues to shrink over the long term, it's natural that reserve currency preferences would eventually start to shift too. Especially if alternatives, like the euro or perhaps a more convertible Chinese renminbi, become more attractive and accessible. And finally, just general policy missteps, things seen as unfavorable or discriminatory towards foreign holders of U.S. assets, could also encourage diversification.
So it really sounds like a combination of factors, things the U.S. controls, like its own fiscal and monetary policy, and broader global economic and geopolitical shifts.
What about the timeline? Are we talking decades? Or can something happen faster?
The historical example that keeps coming up in the sources is the British pound sterling. It was the world's dominant reserve currency before the dollar took over. And its decline wasn't like flipping a switch after World War II. It was a very gradual process. It really unfolded over decades, arguably taking more than 30 years, well into the 1970s, for the transition to the dollar system to be fully complete.
So slow and steady, not sudden collapse. That seems to be the base case suggested by the sources, yes. Barring some kind of unforeseen catastrophic shock like a U.S. debt default, which is generally seen as very low probability, or maybe hyperinflation. Most forecasts cited show the dollar's share of global reserves declining gradually over the next few decades, maybe settling somewhere in the 40–50% range. That would lead to more of a multipolar currency system, with several major currencies sharing the stage, rather than one single currency replacing the dollar outright.
So let's try to synthesize all of this. We've looked at the indicators, the mechanics, the long-term risks. What does this picture of potentially cracking trust really mean for you, the listener?
Well, according to the sources we've reviewed, it means that while the US dollar is still central, dominant in global finance today, that era of completely unchallenged dominance and the exorbitant privilege that comes with it is slowly but surely being tested. The signs we talked about, the weaker auctions sometimes, the strategic diversification by central banks, the changing patterns of foreign holdings, they all point towards increasing pressure on that status. And for the U.S. economy, the potential implications over time could include, as we discussed, higher borrowing costs. Not just for the government, but potentially trickling down to you as a borrower for mortgages, loans, etc. It could also mean increased sensitivity to inflation coming from import prices if the dollar weakens structurally. And it likely implies a growing need for the U.S. government to exercise greater fiscal discipline simply because borrowing might not be as easy or cheap.
And looking beyond the U.S. globally, it suggests a potential shift in power dynamics, right? As other currencies, other economic blocs maybe gain more influence.
Yes, that's a key implication. It could mean the U.S. has to navigate a world where its financial leverage, that unique tool, is perhaps diminished. It might need to rely more on other instruments of influence, diplomacy, trade policy, strengthening its fundamental economic competitiveness. But the sources also note that the U.S. isn't just a passive observer here. There are things it can do to mitigate these risks.
Like what?
Things like maintaining fiscal responsibility, preserving the independence and credibility of the Federal Reserve, being judicious and multilateral when using financial tools like sanctions, and investing in the core strengths of the U.S. economy, innovation, productivity, education. These things can bolster confidence.
So it sounds like the comparison to the British pound is relevant again. Britain adjusted, right? It survived losing the top currency spot, even though it meant significant changes. The sources seem to suggest something similar could happen with the dollar, not an end, but a major recalibration.
That seems to be the underlying suggestion, yes, a recalibration. The U.S. would obviously remain a major, powerful economy, but it might have to adapt to a more constrained reality, one where that automatic global demand for its debt isn't quite as strong, where it faces more competition. It's definitely a high-stakes situation, as the sources make clear. The future role of the dollar seems intimately tied to how well the U.S. manages its own economic house and its leadership on the global stage.
It certainly leaves you with a lot to think about concerning the very foundations of the global financial system.
It does, a lot to watch.
Okay, here's a final thought for you to chew on. If the U.S. does face a future with less of that exorbitant privilege, maybe requiring more fiscal responsibility, maybe leading to a slightly smaller global financial footprint, could that period of difficult adjustment, perhaps paradoxically, ultimately lead to a U.S. economy that's actually more resilient, one that competes more on fundamental strengths rather than just legacy status, even if it means being in a less uniquely dominant position in the world? Something to ponder.
The pound didn't fall overnight, neither will the dollar. But a system built on trust can be undone by hesitation, weak auctions, strategic selling, silent diversification. These aren't headlines, they're signals. And if enough of the world starts asking whether America can pay its bills, the question becomes self-fulfilling. What happens when rates rise, credit tightens, and debt comes due, all across the system? We're running it through the machine.
Please like and subscribe.